Personal finance practice problem using OneNote. APR simple interest example. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab down in the 5175 APR Simple Interest Examples tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. We're looking at the APR and interest, thinking about the differences between the APR calculation and interest and how the APR might help us to make comparisons between different loans. APR, in essence, helping us to roll in the costs into one basically percentage number, which might give us a better number to do comparisons between loans, especially when the loans are breaking out their costs between the interest that's being charged, kind of like the rent on the loan, rent on the purchasing power of the money, and the fees, which they're often going to be saying is for the creation of the loan. But to us, they're all costs, right? And we'd like to be able to compare the costs in such a way that would be making sense, one compared to the other. So we'll start off with a loan that doesn't have any costs. In that case, the rate will be the same as the APR. Then we'll add costs in a couple different ways. So we're going to say that the loan is going to be the $100,000, the interest, meaning we're going to determine that after a year, we had paid interest of $5,000. So we'll figure out what the rate will be. Later on, we'll give the rate, and we'll do it that way as well. We're going to assume that the interest is paid at the end of the loan. So to make it easy here, we're just going to say $5,000. We got a loan, $100,000. We're going to pay it back plus the interest of the $5,000 at the end of the loan. What then would be the calculation? Both the APR and the rate of interest would be the same, simply taking the amount of interest we paid over that 1 year time period, 5,000. We're looking annual amounts here. 5,000 divided by 100,000 gives us 0.05 or 5%, APR being the same as the interest. Then, of course, we're going to add fees. So now we have the same scenario. We got the loan, 100,000, the interest of the 5,000, but now there's fees that they tacked on here. Obviously, this loan would be worse than the last loan if we didn't have any fees, but you can imagine a situation where the loan where the interest rate is like slightly lower in one situation and the fees are going to be less versus a higher interest rate and the fees are more. And that's going to be more difficult to calculate if we were to expand this over multiple time periods. So we'll keep it in 1 year now so we can see the comparison clearly. So we've got the the 100,000 loan, 5,000 on the interest, fees, and we're going to imagine everything's going to be paid back once again at the end, both fees and the interest, which is a little bit different than some loans might be set up, but that's how we'll set it up first. And then we'll take a little bit of an alteration look at that in a second. So we have the interest and fees paid at the end. So the calculation here would look something like this. If we were just to calculate the interest, same calculation. We're just going to be looking at the 5,000, in essence, the rent, not taking into consideration the fees. We once again get to the 5%. But we have fees. So how can we add those on there? The dollar amount doesn't help me to do comparisons because I need a ratio, typically some kind of percent or something of that nature to do comparisons more easily. Therefore, we're going to be taking the interest and fees, the 5,000 for the year and the fees that we're going to pay, assuming both of them paid at the end of the time period. That gives us the 5,300. Comparing that then to the 100,000, let's do that real quick. 5,300 divided by the 100,000, moving the decimal 2 places over, gives us the 5.3%. Now, that gives us a number that's a little bit easier for us to make comparisons. If I compare that, obviously, to the prior loan where I didn't have any fees, the one with the higher APR is worse. We'd want the one with the lower APR. Now, you can find APR calculators on the internet here. So here's just one example of an APR calculator. We got the $100,000 loan. The interest rate, I got to use the interest rate here instead of putting in the interest and letting it calculate the interest rate. So I'll put the interest rate here. We're going to say it's annual, and number of payments 1, and the payment frequency annual. So then I'm going to put in the fees of the 300, and then it'll give us our calculation, the APR. Notice it gave me an APR of 5.315, because normally when I look at these types of these APR calculators, they're usually going to be adding it to the loan. So that's the typical kind of scenario. And so meaning if I was to look at this scenario, then that $300, normally we would say, I need that $100,000 to pay for whatever I need to pay for. And then they're going to charge me interest, which is going to go along with the loan. And then they've got these fees. Now, oftentimes they'll just say, hey, look, we're going to take the fees up front when we create the loan, tack it onto the loan, and then you pay the fees over the term of the loan, which in this case, it's only 1 year. So in that case, notice it's a little bit different in that we're not going to be paying the fees at the end generally. I mean, we kind of will, but they tacked it on to the loan, right? So the person that generated the loan basically paid themselves with the loan and then tacked on the fee that we're going to pay throughout the loan, which in our case is just 1 year later. So that means the fees are on there at the beginning. That's why it's a slightly different calculation with the 5.315 compared to what we got at the 5.3, because our assumption here is that we put it on the end. And then they have the 100,000 loan, total payments 105,315, and the total loan. So they made the loan now at the 100,300 because they tacked on the fee to it. So let's look at that calculation here. We have the APR fees added to the loan balance. So now we're going to do the similar fashion as we saw with the APA calculator, the way it's typically set up in an APA calculator, often the way it might be set up in an installment type of loan situation with the fees. So you got the loan at the 100,000, the fees are going to be 300. That means that the loan is now 100,300, meaning when they set up the loan, they said, hey, we're going to basically pay ourselves now. You need 100,000. We're going to pay whoever else, to pay for that, give you the 100,000 to pay for that. And then we're going to pay ourselves the 300 for the creation of the loan. And we're going to say then the loan balance is now 100,300. So you kind of paid up front for the 300 then. And that means that's your new loan balance. So you're going to be paying interest now on the 103 instead of just simply the 100. So then we have the interest rate at that 5%. That would give us now, instead of 5,000 on the interest, we had to tack on that added 300, about 5,015 for the interest. Plus you have the fees that they added that you're paying off as you pay through the loan. So that's going to give you then the interest and fees, which is now, instead of 5,300, as we saw in the last scenario, 5,315. And that compared to the 100,000, 5,315 divided by 100,000, then giving us that 5.315 that we saw in the calculator, online calculator. Let's do it one more time. This time, let's just add the $900 for the fee. So same kind of scenario, 100,000 loan. We have the interest at the 5%. The fees now are going to be 900 instead of 300, and compare and contrast that. Same case in the first case, we're just going to calculate the interest, which is straightforward. This time we're taking the 100,000 times the rate. This is more likely what we would actually see in practice, meaning they give us the rate and then we can calculate the interest on it rather than us figuring out how much interest we owed to kind of back into the rate. So now we know the rate. If we take the 100,000 times that interest rate, we get to the interest that we're paying over that year's time period, which is 5,000. So we get back to these same two numbers, 5,000 and the 5%, as we've seen in the past, but this time more likely what we would see in practice, us given the rate and then calculating how much interest we would basically pay. Then if we consider the APR, we'd say, okay, if I take this same scenario, we got the interest plus we're going to pick up the fees. We're doing this once again, assuming the fees happen at the end of the term loan, which is just 1 year in this case. So now we're going to have paid after 1 year 5,000 of interest and the fees at the end. That gives us the 5,900. If we compare the 5,900, 5,900 to 100,000, move the decimal 2 places over, that's going to give us the 5.9%. 5.9%. And then let's do it the one more time. This time we're going to do it in the situation where they tack on the fees to the loan, which is often the case for an installment type of loan. So we got the loan now, the $100,000. If they say, okay, you need $100,000, we'll give you that, and we're going to pay ourselves the $900 for setting up the loan. Therefore, your loan balance at the beginning of the year is $1,900. Now, there's only going to be one time period, so we're going to pay that at the end, and that means you're going to pay the 5% annual. So now we have, instead of $100,000, we got 109 times the 0.05%. That means we're going to be paying the $5,045 of interest plus the fee, which was that $900. So we say plus the $900. That's going to give us then the $5,945. Comparing that then to the $100,000, we get the rate of the 5.945 if I move the decimal 2 places over on this one. Now again, this one, notice we can compare it to the prior APR rate. We typically would want the lower rate, and we now have something that's a little bit more easily comparable. If we put that into our online calculator, we'd say, okay, same thing, 100,000, 5% loan, but now these are going up to 900 on the fees. And that's going to give us our APR of the 5.945. And that's what we got, the 5.945. So that gives us a nice comparable number. Now note, there are situations where the APR wouldn't be enough just to in and of itself possibly. And one major scenario that you'll probably run into or could possibly run into and hear about is the idea that if you have a 30-year loan on something like a mortgage, then if you're comparing something that has a higher upfront cost versus another loan that has less upfront cost, and they have the difference in the interest rates is compensating for that, meaning one loan has higher upfront costs but less interest rate, the other loan has less upfront costs and higher interest rates, then you could end up with a situation that the one with the higher upfront costs then has a lower APR when you calculate this over a 30-year period. But the question would be then, are you going to keep the loan for the 30-year period, or are you going to be expecting to, even though you got a 30-year loan, to be selling the home and closing it out in a shorter time period? And in that event, because you can see here the way we basically added the fees to the loan cost. So over time it plays out, but the question is, how long do you have to be holding on to the loan before those two basically scenarios will even out? And so we have a practice problem on that if you want to take a look at that kind of situation in more detail.